The vaults are screaming. Right now. This second. Silver just crossed $67.46. This isn't a rally. This is structural failure. The average person sees a price chart. The vault managers at COMEX see extinction. The bullion banks in London see panic. The industrial buyers scrambling for metal see war. This is the sound of a 150-year control grid shattering in real time. We're not watching a market. We're watching the vault leak. 4 trading days. 47.6 million ounces ripped from COMEX registered silver. That's 60% of the deliverable float. Gone. This isn't profit taking. This isn't speculation. This is industrial users, sovereign nations, and banks hoarding physical because they know what the screens won't show you. The vaults are going to zero, and when they hit zero, price doesn't climb to $70 or $80. It teleports to $100. We're about to expose the vault leak. We're going to show you what the COMEX kill switch was and why it just shattered. We're going to reveal the inventory collapse that proves the paper market is a mirage. And we're going to map the path to $100 per ounce, a number that sounds delusional today, but looks locked in by Monday morning. The banks fired their kill switch December 12th. Margins up 50%. They tried to crash it. The market laughed. Let's begin. December 20th, 2025. Why does this day matter? Because something just happened that has never occurred in modern silver trading. Silver touched $67.46 this morning. Settled at $67. That's 132% for the year. Let me say it again. 132%. Gold, the media darling, is up 65%. Silver just became the #1 performing asset class on Earth. But the price is not the story. The story is this. For the first time in recorded history, silver stayed above $62 for an entire 5-day trading week. No dips. No flash crashes. No Friday execution. The banks spent 5 days trying to shake you. Margin hikes. Short contracts. Stop loss triggers. They failed. Look at the close. $67. We are not holding high ground. We're fortifying it. Every hour silver refuses to drop is another hour the paper market bleeds credibility. For 40 years, every time silver broke out, COMEX used emergency protocols to smash it. 1980-2011. They tried again December 12, 2025. But this time the kill switch didn't fire. Physical demand is too violent. The vaults are too empty. And the world just realized the emperor has no silver. This weekly close is the verdict. It tells the algorithms, the hedge funds, the sovereign wealth managers, the breakout is real. The paper manipulation is finished. The physical squeeze has started. Let me show you the numbers Wall Street is hiding. Official COMEX vault reports, published daily. They expose the greatest inventory crisis in commodity history. The 4-day hemorrhage. First week of December, 60% of all registered silver claimed for delivery. 47.6 million ounces walked out in 96 hours. Registered silver is the free float, the metal available to settle futures. When registered drops, liquidity dies. Single day record, December 9th. Traders demanded delivery on 7,330 contracts. That's 36.65 million ounces. In 6 hours, 30% of COMEX's entire deliverable inventory was claimed. The 5-year collapse. Since 2020, total COMEX inventories down 73%. This isn't traders shuffling metal. This is permanent removal. Industrial users buying it to build solar panels. Sovereign nations hedging currency collapse. It's leaving the system forever. The London connection. LBMA vaults down 66% year to date. Combined global vault inventories dropped from over 1 billion ounces to under 500 million. At current delivery rates, analysts estimate COMEX registered vaults hit zero by December 23rd. That's 3 days from now. This is the vault leak. not a data breach, a physical drain, and it's accelerating. There's a technical term that sounds boring but signals absolute emergency: backwardation. Right now, silver futures are trading 60 cents below spot price. Let me explain why that's a 5-alarm fire. Normally, futures trade above spot. Storage and insurance cost money. Futures price includes that cost, contango. But when futures trade below spot, it means one thing. Nobody wants paper promises. They want the metal. Now, think of backwardation like a bank run. 2008, people lined up to withdraw cash. Banks couldn't say, "Here's an IOU." They had to deliver real dollars. Right now, industrial buyers are lining up at COMEX saying, "Give me the silver." And COMEX is running out. This 60-cent backwardation equals $3,000 per contract in lost profit for paper holders. Traders are screaming, "I don't care about the loss. Give me the metal before the vault empties." When profit becomes irrelevant, when fear replaces greed, markets go vertical. Last time silver hit sustained backwardation was March 2020 during COVID panic. Price shot from $12 to $30 in 4 months. But that backwardation lasted 2 weeks. This one has been building for 2 months. The spring is coiling tighter every day. There's a pattern forming right now that professionals recognize instantly. After silver exploded $60 to $67 in a straight vertical line, the natural expectation was a crash. Pull back to $62, maybe $58, shake out weak hands. But silver didn't crash. It stopped, went sideways, trading tight between $66 and $67.50. This is the healthiest pattern in a bull market. Bull flag. Picture a flagpole shooting straight up. That's the rally from $60 to $67. Now picture a flag waving at the top. That's consolidation. This flag is not weakness. It's recharge. Imagine holding a beach ball underwater. The banks are using all their strength pushing down. The pressure of the water, the buyers, pushing back up. Right now, the forces are equal. That's why price looks flat at $67. But the banks are getting tired. Their arms are shaking. And the moment they let go, the beach ball doesn't float gently. It explodes. This consolidation is building energy for the next leg. When bull flags break, they don't break softly. They gap. We could open Monday morning at $72 without warning. That's not hype. That's technical probability based on 100 years of chart patterns. There's a psychological component to $67. For a generation of silver investors, anything above $50 was fantasy. The moon. People said, if silver ever hits $50 again, I'm selling everything and walking away. Well, we blew through $50, blew through $60, sitting at $67. And guess what? People aren't selling. Sure, a few weak hands took profits at $65. But the mass exodus didn't happen. The stackers are holding. ETF investors are holding. Why? Because they realize $67 isn't the top. They look at vault data. They look at industrial demand. They look at solar companies desperate for metal. And they realize $67 is base camp. This is the psychological shift that creates a super cycle. The banks were banking on you selling. They thought, if we let it hit $67, retail sheep will dump and we can buy back cheap. But the sheep didn't dump. The sheep became wolves. We realized the value of what we hold. We're not looking for an exit at $67. We're looking for an entrance at $100. This change in psychology separates a rally from a generational wealth transfer. When high prices don't cure high prices, when high prices create more demand because people fear being left behind, things go parabolic. Let me remind you what didn't happen this week. It's Friday. Historically, Friday afternoon is smash time. Economic data drops. Dollar rallies. Silver crashes. We've seen the script 1,000 times. Traders call it Slam Friday. We were ready for it today. Braced for silver to drop to $64, maybe $62. But the smash never came. The dog didn't bark. Because the physical market is too tight. Vault managers know they can't deliver. If banks try to smash paper price to $64, industrial buyers step in and demand more physical. They say, "Thank you for the discount. We'll take another 10 million ounces." The banks lost their power to manipulate downward. They can only stall. They can only force sideways. But they can no longer crash it, because every time they lower price, delivery demands surge and the vault crisis worsens. This creates a floor. Concrete floor at $66. We're walking on that floor right now, and it feels solid. The market isn't scared of pullback anymore. The market is scared of missing the next leg up. So we've established price at record highs. Vault's draining. But what actually happened December 12th? What is this kill switch and why did it break? If you're just joining, let me catch you up on the battle 8 days ago. December 12th. Silver trading at $64, pushing $65. Momentum undeniable. Retail piling in. Institutions capitulating. Shorts panicking. Then at exactly 2 p.m. Eastern, COMEX drops the hammer. Emergency margin hike. 50% overnight. If you wanted to hold one silver futures contract, you now needed $22,000 in your account instead of $14,000. That's an instant $8,000 cash call. If you don't have it, your broker liquidates. You're forced to sell. This is the kill switch. COMEX's nuclear option. They've used it before. 2011, when silver rocketed toward $50, they raised margins 5 times in 9 days. Price crashed 30% in 2 weeks. Fortunes wiped out. Rally killed. So when they pulled the kill switch December 12th, smart money prepared for bloodbath. They expected silver to drop to $60 or lower. Expected panic selling. Expected capitulation. But something impossible happened. The price barely moved. Silver dipped to $63.50 for 90 minutes, then rallied. By end of day, closed at $64.20. The kill switch didn't work. Why? Because the buyers in this market aren't leveraged speculators. They're industrial users paying cash. Sovereign wealth funds paying cash. Billionaires like Robert Kiyosaki converting fiat into metal. You can't margin call someone not using margin. The kill switch was designed to liquidate weak hands. Gamblers trading on borrowed money. But there are no weak hands left. Everyone still holding silver at $67 is a true believer or an industrial user who needs the metal to manufacture products. The banks realized their weapon was useless. Worse, the margin hike had unintended consequence. It scared away speculators, yes, but it also scared away paper sellers. The only people left were physical buyers. So instead of crashing price, the margin hike accelerated the squeeze. This was the moment the paper market broke. The moment the 150-year price suppression mechanism failed. And the professionals knew it. Within 48 hours, JPMorgan moved 13.4 million ounces from registered to eligible. Translation: they pulled their silver off the market to protect it from delivery claims. They saw the writing on the wall. Let me paint the picture of what's happening behind closed doors right now. Imagine you're head of commodities at a major bullion bank. Your job for 20 years has been simple. Sell paper silver contracts to keep price low. Protect the dollar. Protect the bond market. Make sure silver never competes with treasury bills as safe haven. For 20 years, this worked perfectly. You sold 100 paper ounces for every 1 ounce physical in the vault. Nobody ever asked for delivery. They just traded contracts back and forth. Beautiful scam. You collected fees. Controlled price. Life was good. But then 2025 happened. Solar boom. AI data center explosion. EV revolution. Suddenly industrial users started saying, We don't want your paper contracts. We need the actual metal. And they started demanding delivery. At first, you weren't worried. You had 200 million ounces in registered vaults, plenty of cushion. But then demands kept coming. 10 million ounces in October, 20 million in November, 47 million first week of December. Your vault is now under 130 million ounces. And there are 500 million ounces of paper contracts still outstanding. You do the math. If even 30% of contract holders demand delivery, you're finished. You can't deliver metal you don't have. You'll default. Word will spread. The entire commodities market will lose confidence in COMEX. Trading moves to Shanghai. Your 150-year institution becomes irrelevant overnight. So you panic. You call the other banks. You call regulators. You beg them to do something. Raise margins. Halt trading. Anything to stop the bleeding. That's what December 12th was. The sound of institutional panic. But it's too late. The genie is out. The vault leak has been exposed. And the world knows the emperor has no silver. Now let's talk about who's actually draining these vaults. Not Reddit traders. Not retail stacking coins. The real buyers are giants, players moving billions, and they're not buying silver to trade it. They're buying it to own it forever. First, the solar industry. Right now, solar panels consume 29% of all silver production. 10 years ago, it was 11%. Why the explosion? Every solar panel needs silver paste to conduct electricity. There is no substitute. You cannot build a solar panel without silver. And the world is building solar farms at record pace. By 2050, according to industry projections, solar will require 98% of all known silver reserves. Let that land. Every ounce of silver ever mined used just to power solar. That means almost nothing left for coins, jewelry, or investment. The entire above-ground supply locked inside solar panels on rooftops and farms. These solar companies aren't buying futures contracts. They're taking physical delivery, signing long-term supply deals directly with miners, bypassing COMEX entirely. This metal is gone permanently. Second, the EV revolution. Every electric vehicle uses 25 to 50 grams of silver. That's 79% more than a traditional gas car. And the world is transitioning to EVs at breakneck speed. China already at 50% EV market share. Europe banning gas cars by 2035. United States subsidizing EV production with billions in tax credits. Tesla alone projected to produce 20 million vehicles per year by 2030. At 50 grams per car, that's 1,000 metric tons of silver every year. Just one company. Multiply that by every other EV manufacturer on Earth. The demand is staggering. And it's not optional. It's mandated by governments. Third, AI data center boom. AI models like ChatGPT require massive server farms. These servers use silver in circuit boards, connectors, cooling systems. Data center power consumption up 252% since 2020. And we are only in the first inning of AI revolution. Companies like Microsoft, Google, Amazon building data centers the size of football fields. Each requires tons of silver. And they're not waiting for prices to drop. They're signing supply contracts at any price. Because if they don't secure silver now, they can't build infrastructure to compete in AI. Fourth, sovereign nations. For the first time in modern history, countries like Russia, Saudi Arabia, India bypassing dollar system and buying physical silver for national reserves. Why? Because they see the same vault data you're seeing. They know supply is running out. They know fiat currencies are being devalued. They want hard assets. When a sovereign wealth fund places order for 50 million ounces, they're not calling a broker to buy futures. They're calling a refinery to mint bars, sending planes to pick up metal. This is nation-state buying, and it's accelerating. These four forces, solar, EVs, AI, sovereigns, creating a demand tsunami COMEX cannot handle. The paper market was never designed for this. It was designed to handle speculative trading, people buying and selling contracts they never intend to deliver. But now everyone wants delivery, and there's not enough metal to go around. This is why the vault leak is unstoppable. You can't print silver like you print dollars. You can't create it with a computer. You have to dig it out of the ground. And global silver production has been flat for 5 years while demand exploded. The math is simple. Supply, 1 billion ounces per year. Demand, 1.4 billion ounces per year. Deficit, 400 million ounces per year. That deficit has to come from somewhere. It's coming from the vaults. So the algorithms are triggered. Industrial buyers relentless. Vaults draining. Kill switch failed. But where exactly are we going? What are the price targets? If $67 is base camp, where's the summit? Zoom out. Stop looking at hourly chart. Stop obsessing over daily candlesticks. Pull up monthly chart going back to 1980. What do you see? Massive peak in 1980 at $50. Then 30-year bear market. Long painful grind down to $4 by 2001. Then recovery. Rally to $50 again in 2011. That created a giant cup, U-shaped pattern that took 30 years to form. Then from 2011 to 2024, we formed the handle. 13-year consolidation. Slow drift lower. Shaking out every weak hand, every impatient investor, every person who gave up and said silver is dead. And now in 2025, we are breaking out of the handle. This is the cup and handle pattern, the single most powerful formation in all of technical analysis. And the bigger the base, the higher in space. A pattern that takes 45 years to form doesn't resolve with a $5 move. It resolves with a measured move to the moon. To calculate target, take depth of cup from 2001 low at $4 to rim at $50. That's $46 range. Add that range to breakout point. $50 plus $46 equals $96. That is the geometric target of this pattern. $96 per ounce. Not based on fundamentals. Not based on supply and demand. Based purely on mathematics of market behavior and human psychology. We're currently at $67. Barely 2/3 through the measured move. This tells us we are not at end of cycle. We are in middle innings. Now let's zoom in. Short-term roadmap. Traders use Fibonacci extensions. Mathematical ratios found everywhere in nature. Spiral galaxies. Nautilus shells. Sunflower petals. And in human psychology, markets move in Fibonacci ratios. Most important is 1.618 golden ratio. If we measure the move from $50 breakout to current $67 high and project upward using golden ratio, next extension lands at $72. This is not a guess. This is where algorithms are programmed to take profits. This is where next wave of resistance forms. Between $67 and $72, there's very little price memory. Silver hasn't spent much time in this range historically. This means low friction. We could move $67 to $72 much faster than we moved $60 to $67. The air is thinner up here. The moves are bigger. So if you're watching the screen next week and silver jumps to $69, $70, $71 in a single day, do not be surprised. It's simply the market filling the vacuum up to golden ratio. Beyond $72, next Fibonacci extension is $80. And beyond that, the psychological magnet of $100. Round numbers act like black holes in markets. They pull price toward them. We conquered $67. Next magnets are $70, $80, $100. Here's what experts are saying publicly. Robert Kiyosaki predicting $100 to $200 silver by 2026. Citigroup just raised their 2026 price target to $72. Independent analysts saying if COMEX registered vaults hit zero, which could happen as soon as December 23rd, price will skip $80 entirely and gap straight to $100. Why $100? Because at that point, paper market will be completely decoupled from reality. Physical silver will trade in the hundreds while paper contracts trade in the 40s or 50s. Two separate markets, and everyone will want the real metal, not the paper promise. We've reached end of trading week. Closing bell ringing. Algorithms shutting down. Bankers heading to the Hamptons. Price of silver standing tall at $67.14. Take a moment. Breathe. Do you realize what just happened this week? Banks threw everything at this market. Tried to trigger sell-off with margin hikes. Tried to plant fear in media. Tried to defend $65, then $66, then $67. They failed at every level. This week will go down in history books. We broke above 1980 inflation-adjusted high. We triggered vault drain emergency. We exposed kill switch failure. We confirmed cup and handle breakout. But now we enter most dangerous phase for an investor, the weekend. For the next 48 hours, markets are closed. You cannot buy, cannot sell. You're left alone with your thoughts, left alone with news headlines. And this is where mistakes are made. There's a famous story about Jesse Livermore, greatest trader of the 1920s, made millions during the Great Crash. One day a young trader asked him, "How did you make so much money? Did you trade every breakout, short every dip?" Livermore looked at him and said, "It was never my thinking that made the big money for me. It was always my sitting." Sitting sounds easy. It's the hardest thing in the world. Right now, you're sitting on massive unrealized profit, or you're sitting on a position you bought at $50 or $60. Your brain wants to do something. Lock in gains. Hedge risk. Be smart. This weekend, you're going to see headlines. Maybe a scary article about COMEX investigation. Maybe geopolitical rumor. Maybe an analyst on TV saying silver is overextended. Your brain will say, maybe I should sell half Monday morning just to be safe. This is the enemy. In a super cycle, which is what we are in, big money is made by identifying the trend and then sitting on your hands until the trend breaks. Has the trend broken? No. We just closed at all-time high. Has vault crisis ended? No. The drain is accelerating. So why would you do anything? The Livermore rule says if the trade is working, do not touch it. Do not prune a flowering tree. This weekend, your only job is to suppress the urge to be clever. Being clever gets you killed. Being patient gets you rich. You need to understand the media cycle. Financial news networks need content on the weekend, but markets are closed. No price action to report. So what do? They manufacture fear. They'll find a guest to say silver is in a bubble, dig up an old analyst to warn about double top, spin narratives designed to keep you glued to the screen. You must ignore the weekend noise machine. Remember, people on TV are not holding physical silver. They're paid salaries in fiat currency to read a teleprompter. They don't understand vault data, don't understand solar demand, don't understand sovereign buying. If you let the noise into your head over the weekend, you'll wake up Monday anxious. You'll check pre-market at 4 a.m. You'll be looking for a reason to sell. And the moment there's a tiny dip, you'll hit the button. Then 2 hours later, price will rip to $72 without you. This is how they steal your position. They use the weekend to plant seeds of doubt. Your defense is simple. Turn off the TV. Close the browser. Go outside. Spend time with your family. The price will be there Monday morning. Staring at it Saturday does not change it. However, we must be prepared for Sunday night because of the strength of this weekly close, because we held $67 in face of maximum selling pressure. Probability of a gap up when Asian markets open is extremely high. China will see this weekly candle. India will see that U.S. banks failed to smash price below $65. This signals weakness in the West and strength in physical. So the East may attack. We could see silver open at $69 or even $70 Sunday night, 6 p.m. Eastern. If this happens, do not chase it with leverage. Gaps often get filled. Price might jump to $70, then pull back to $68 to test support. If you're looking to add to your position, do not buy initial Sunday night spike. That's panic buy from people who were on sidelines all week. Wait for retest. Wait for market to settle into range. Let the dust clear. But if you're already holding physical or core position, just smile. A gap up is the market telling you supply is so tight price has to teleport higher just to find a seller. On the flip side, if some unexpected news breaks and we gap down to $65 on Sunday, do not panic sell. Remember the bear trap. Sunday gaps down are almost always bought back by Monday afternoon. Stick to the plan. Stick to the trend. I want to close with a thought on conviction. For years, silver investors lived on hope. We hoped manipulation would end. Hoped industrial demand would save us. Hoped dollar would weaken. Hoped vaults would run dry. This week, hope died, and it was replaced by certainty. We don't have to hope anymore. We saw banks fail to crash price. We saw vault data confirm the drain. We saw $65 wall, $66 wall, $67 wall all crumble in 1 week. We are no longer speculating on theory. We are watching reality unfold in real time. The deficit is real. The shortage is real. The vault crisis is real. The price action is real. This shift in mindset is critical. When you operate from hope, you're easily shaken. When you operate from certainty, you're unshakable. You're holding the most undervalued strategic metal on earth at the precise moment it's being repriced by a desperate industrial complex in a collapsing paper market. You don't need to hope. You just need to wait. Here's the verdict for the week. The bulls won. It was not easy. It was war, but we closed at $67.14. We closed above every resistance level. The technicals are screaming continuation to $72. The fundamentals are screaming shortage to $100. The psychology is shifting from skepticism to fear of missing out. Next week, the battle will likely shift to the $70 level. It will be volatile. There will be fake outs. There will be moments of doubt. But you are ready. You have the data. You have the roadmap. You have the conviction. Enjoy your weekend. Turn off your phone. Spend time with people you love, because Monday morning the war continues.